Hello everyone, this is Jimmy Singh, broker owner of Supermax Realty. Welcome to my channel, Real Estate Edge with Jimmy Singh. In today's video, I like to talk about the sales stats for London, St. Thomas, Middlesex County housing market. And also I like to answer some of the questions in this video put forward by some of our viewers. And the big questions right now on everybody's mind is, will the mortgage rates continue to rise? And some of the people are asking me, is it a good time to buy, sell, or invest in real estate? So in this short video, friends, please watch till the end because I'm going to touch different topics that impact our housing market. Number one is interest rates. Second, what is the property types that are affected since 2022 downturn in London, St. Thomas areas. Third is what kind of current cycle we are in and what to expect in spring and summer markets of 2023 in regards to sales and housing. Then I'm going to discuss the factors or fundamentals that drive the house prices in Canada. And lastly, I will discuss the stats put forward by our board for the month of February. So let's start with rates first. So first thing I like to say is that's my personal opinion. I still feel we might see more rate hikes this year, though the Bank of Canada has a meeting tomorrow in March, but they might give it a pause this time. But since the inflation is still running high, a job market is still very strong. A simple Google search will tell you that how many people government agencies are hiring. Yes, there is some job losses in IT sectors, in some service sectors, but those are not the numbers which Bank of Canada wants to see to make their rate adjustments. And yes, I see the light at the end of tunnel. Why? Because I see the decline in housing prices in our area. They are now slowing down. I see certain property types, there's now resistance of the sellers not to underprice the property, and they're just taking the property off if they can't sell those houses. Then again, there's a little uptick in the sales stats month over a month. For the February, we will delve deep into it. So yes, please don't read the headlines in the magazines. Don't read headlines on the news channels because they just want to grab your attention. They want to get extra eyeballs to sell their stuff. Recently, there was somebody saying that there was a news that Bank of Canada is going to pause interest rate for the whole of 2023. That is not true, friends. If you read the article, there was just a poll conducted by different professionals and they of the general opinion. Personally, the environment we are in right now globally, it's very hard to predict how the next 6 months is going to be. So please prepare accordingly. And as I said, my personal opinion is we might have more rate hikes, maybe not in March, again maybe in summer, or they will visit looking at the data for inflation and employment and make the decision. And now talking about the different property types and how they are faring up in February of 2023. See friends, the top tier or what we call a premium luxury market, meaning expensive houses, 1.2, 1.5, 1.8, $2 million. I feel particularly in London, St. Thomas area, those have gone and led the downturn in 2022 versus lower or middle price houses. What that means is basically the most expensive houses in our market always tend to lead the cycle, whether it's up cycle or down cycle. Meaning if some house is worth at the peak maybe March 2022 maybe for 1.8 million, right now it's down $300,000-$500,000 versus a townhouse which were selling maybe 750 or 800, they are down at this point of time maybe 200,000. So yes, luxury market was impacted a lot because when the interest rates are suppressed artificially low, people just focus on their payments, and they said, you know what, we can buy a big palatial house. Now with the rates hovering around 5.5%, it's getting very hard for people to qualify at today's stress test rate of 7+%. So that market is going to be drag for sure. But the good part is I'm seeing now lower listing volume in the luxury or high-end market. What that means is fewer properties for sale. Hence, it is helping now the luxury market from the further downward pressure. Whereas I'm seeing listings grow in lower and the middle tier of London St. Thomas, meaning a lot of supply, especially in London, is hitting the market. And in the stats, we will talk about that. The stats for the active listings at the end of February were 1,320 homes for sale, meaning there's a lot of options for the buyers. So we'll get into those details. And suddenly, the stat says we see sudden uptick of sales numbers. So when you see the media release put forward by the board, they will say, month over month, our prices, have risen. That is true at certain extent. My explanation for that is there might be some people who wanted to buy last year in 2022, but were afraid and thought the prices are coming down. And those are the people right now, they jumped into the market. Maybe they have mortgage approvals from October, November, December, and now their family situation is such they can't stall or delay or postpone their purchase. So those are the people, they know if we can't pull the plug, we might have to qualify at a higher rate. So those are the people, waiting, watching people, they bought in February, and but that 1 month uptick is not a trend. So I still have to see the sales number for the month of in spring market and summer for us to see conclusively that the market is now going up or is going in a positive direction. So now talking about the current cycle. So see friends, we are transitioning from once in a generation boom, which was there in pandemic 2020, 2021, and earlier 2022 February or March market. Now we are transitioning into adjustment phase where people are setting their, adjusting their expectation for the house prices. And now in the cycle, we are into the next phase of real estate, which is stabilization phase. So now prices are going to stabilize in next few months. Then, the next cycle will start. So that is the preparation, right? And my, thought was once the inflation or the interest rates peak, then people will have a better confidence in the market, and then they can go out and do big purchases. Recent poll conducted by IPOS and Bloomberg, last couple of weeks ago was saying that right now consumer confidence in Canada is all-time high for the last 6 months. So a lot of consumers are bullish on a real estate market and they are thinking of doing the purchase. But still, don't get me wrong, to qualify the mortgage is still a challenge and it might be drag on the affordability. And yes, interest rates are higher, but my opinion is there are other many factors that will dictate our rising houses prices. I will discuss one at a time. But before I do that, I want to answer another question put forward by our audience. He said, is London St. Thomas market crashing? So let's define what crash is. So crash, I checked the definition in economics. They said crash happens in the marketplace when there's large number of forced sellers and nobody on the other side of the transaction to purchase those properties, and they have to just give it away at significant discount. So friends, you have to understand that home sellers are also home buyers. So if I am looking to upgrade my house, for example, and there is a client in a situation who bought in the peak market, let's say they bought a 600,000 house maybe in 2021, and that 600,000 house is now worth $500,000, meaning it's down $100,000. That person has to take $100,000 loss to buy a bigger property. A lot of people are not willing to do that unless you bought the house pre-pandemic, maybe 7, 10, 15 years ago. You have substantial equity and you can suddenly, jump and buy another property. So that is a drag, meaning those people can't buy. And then there is another subset of people who had their mortgages locked at sub 2%, 2.5%, or maybe 2.93%. And those people are thinking, you know what, if I sell my house, yes, other price of the house is less. The bigger property which I'm looking to upgrade from my condominium, townhouse, or a small house, but now I have to, pay 5.5% mortgage, and then, I have to qualify for a higher rate. So again, those buyers or those sellers, they are sitting on sidelines, and these people also control the supply and demand. Because if I don't see myself moving, out of my house, it means, there'll be less houses coming on the market for sale. And that is exactly what is happening. Right now, I feel the luxury market is at a point where supply is less because people already bought their dream houses last 2 years. They locked and get their interest rate locked for next 4 or 5 years, and they have no desire to move because if let's say they want to buy ultra luxury home or buy investment properties, they see the decline in their equity, so they are sitting tight and not speculating in real estate. And that's actually a good thing as well for many first time buyers. Another thing, for the crash to happen, we have to remember unemployment levels have to rise. So people who are losing jobs left and right. But right now the stats, data put forward by government is showing very, very strong market in the first quarter, which is January of 2023. Government is hiring a lot of people and they have hard time finding young people to join the workforce. And the second thing that can create crash, friends, is obviously the rise in interest rate. But at the same token, as I mentioned in some of my previous videos, that Bank of Canada, your all the big banks or your lenders, they are not here to take your house away. So they are willing to work with you if your mortgage payments have risen. They are trying to increase your amortization to decrease your carrying cost. They're willing to, if you are on a variable mortgage and most of your payment is going towards your interest, they are willing to work with you. So your interest is, added to your principal outstanding, amount. So there's help out there. So you don't need to panic. And if you're living in your dream home, or if you bought a house to live for the next 5-10 years, you don't have to panic. It is just on the paper, or on your neighbor, somebody is selling for less, doesn't mean you lost something. It's just a paper loss. And now talking about what is the fundamental drivers that dictate our real estate prices long term. First thing is land constraint or shortage of land. Second is zoning, another taxes. Then there's population growth. And at the end, obviously, is the trade people available to build those kind of houses. And I know, everybody is aware that government put data forward last year that we need to build 1.5 million homes in next 10 years to, have affordable housing for all the incoming influx of new immigrants and to, for house our population. But looking at the stats for last 30 years, there's no way we can build that kind of housing in next 10 years. First, we don't have that kind of trades. Second, we don't have that kind of service land or lots available. So this is another challenge, folks. The housing price doesn't come only from high construction cost. It also is embedded in each and every house cost. Meaning, let's say you're looking to buy as a builder a land close to London. Pretty much there's not much land available to, meaning service land, where the utilities, sewers, water is already ready. And sometimes there's a lot of red tapeism in the municipality level, so it will take many years for them to give you approval, maybe 3 years, 4 years, 5 years. Hence, the cost of builders, rises. So they have to sell at a certain price point to make the profit and project feasible. If they can't make money, they won't put the project in place. So right now, all the inventory for the new homes in London, St. Thomas, folks, I'm seeing builders have standing inventory. They're giving good deals, to sell it. But then moving forward, if their borrowing cost, meaning higher interest cost mortgages, is going to take a chunk of their profits, they're going to just sit tight and not build, meaning they're just kicking the football down the line. And I see the challenges in next 2-3 years because they're not building much housing. We have lots of people coming in the lovely London St. Thomas area, and everybody want to buy a piece of land to raise their families, and many don't want to live in condominium, meaning high rises. So the property types they're making in GTA right now, folks, it is high rise buildings, 500 square feet condo, 400 square feet condo, 600 square feet condo, and many new immigrants or young families don't want to live there. So it's just, drive till you qualified kind of thing. If you have option to work from anywhere, you will keep driving on 401 or other highways till you find a city which is, suitable for you, and London check lot of boxes. World class, university here, excellent college, Fanshawe. Then they have hospitals, access to 402, 401, inexpensive, not inexpensive, meaning comparative to GTA, we have industrial and commercial land, which is, at a much affordable, price for the builders to develop different projects. So all in all, folks, these factors dictate your house values. Plus, if you do, search online, you will find last year, especially in Toronto area, the development charges were doubled for a builder to make anything. So let's say somebody's buying a condo in, Toronto. I think $200,000 to $250,000 development charges and levies go straight to the city. So a lot of people say, hey, they are greedy builders, but you have to understand, if, from 250,000 goes straight to the city out of 600,000 worth of condo, then there's construction cost, carrying cost, and some of these buildings take 5 to 6 years to finish it. So this is exactly the reason of your high housing cost in Canada. Now again, the house they're making in GTA are the smaller properties, smaller townhouses or stacked townhouses or condominium. So a lot of families will keep coming to these kind of cities like London. Hence the down line, if I see next few years, we will have tremendous demand again, and the cycle will again repeat itself. And lastly, I like to discuss the stats for the month of February. So we have in total 436 houses that were sold in February of 2023 versus, if I take last year, we have 814 sales, meaning sales are down 40 to 50%. Inventory is growing. We have 1,320 homes available for sale at the end of February versus 395 homes which were available in 2022. So 3 months of supply in the market, and it is rising because we are going to normal spring market and summer markets where people tend to list their houses more. So unless we have lot more buyers coming and absorbing these inventories, I see price drag in our city, which is putting pressure on the housing prices, and it's going to take longer for a home seller to sell their house. Then if I talk about home price index, it is down 25% from last year for London St. Thomas, meaning all different property types approximately are down 25% from the peak of 2022. Single family homes are still up 46% from February of 2020. So if we go back 2.5 years, 2 years, still single family home have risen 46%. Townhouses are up 43% from February of 2020. Apartments, they are up 18.2% from 2020 February. So all in all, guys, this market, I feel, has created a lot of opportunity for people who are qualified, sitting with the money, whether you're a first-time buyer, you're investors. If you have a long-term horizon, guys, you're investing for your family or for creating your wealth for next 10, 15, 20 years, you should be fine. Just get a 1 or 2 year fixed rate, ride the wave. Eventually things will be normal. Yes, we are not coming to 2% rates, but yes, it will stabilize somewhere close to 4%, 3.5 down the line. Let's see. So inventory is high. There are a lot of options for new construction. Our team at Supermax is working with a lot of buyers and sellers, securing good, new construction deals in around London area for our clients, because some builders have adjusted their price. They're throwing away good, upgrades in there and give some incentive for the buyers. Second thing is, lot of people we work with, they already understand that, the low rate cycle, mortgage cycle in Canada is pretty much done. We will never see 2%, and they're okay and adjusting to the current environment, which is, high 400 to, close to 5% interest rate. For insured mortgages, we can still arrange our clients 4.5, 4.4, something like that. For uninsured, we still have very good mortgage rates. Just call us at 519-933-2559 to discuss your real estate and mortgages need, or if you're looking to build your dream home. Again, this is Jimmy Singh. Thanks for watching my video. If you want to leave some comments or you feel certain way about the property, kindly share your thoughts at my channel, Real Estate Edge with Jimmy Singh. Thanks for watching.